husband and wife, owned this plot of raw land where they were going to build a golf course. And over time, the land lost a bunch of value. And their bank said, look, you got to get this, deadbeat kind of land off of your books. It's really dragging down the way your financials look. And so, the end of 2009, this entity set up by husband and wife, follow along here. I know everyone's spent, but we're almost there. They arranged a deal where a company set up by their son-in-law, right, was going to acquire this land from the holding company for obviously much less than they paid for it, because that's why they're dumping it in the first place. It had lost so much value, but no valuation was done on the property. They just plucked the value out of thin air. No down payment was issued. And, to come full circle in our day today with a term we've used a lot, this buying company set up by son-in-law purchased it with a non-recourse note. And so basically, if they didn't pay the note, who cared? Now, even funnier, title wasn't going to pass for 5 years until this note was paid. And it was supposed to all be paid in one lump sum in 5 years. But they never had any intention that, the son-in-law was going to pay for this company. They just wanted to move the land. And if they can recognize a loss in the meantime, all the better. So they sell the land to the son-in-law's company for a balloon payment note in 5 years. That's non-recourse. They say they'll transfer the title at that time. But as soon as they sell it, what do? They lease it right back, right? They lease it right back. And the lease says that they, right, the seller, are obligated for basically all the upkeep of this property. They're paying the real estate taxes. They are maintaining the premises, the buildings on the golf course, and they basically bear all the benefits and burdens of this property. And so you can guess already where this is going. They had purchased this property for $770 and they dumped it for a note of $660. And so they took a $110,000 loss. They never got paid penny one on the note. Matter of fact, like a couple months after the sale, the son-in-law sold the note to someone else for pennies on the dollar. So they never got paid a penny for the note, but they claimed a $110,000 loss. And the reason I put this in as our last case of the day is because I just sometimes think when a client comes to us with a sale agreement and says, hey, you have this property on my books with a basis of $770. Here's an agreement that says I sold it for $660. You'll put a $110,000 loss on the return and not think twice about it. But what you have to remember is if you look at case law, there's an old case called Keith. And Keith said, when a sale really happens for tax purposes on the earlier of you transfer title to somebody else or you transfer all the benefits and burdens of ownership of that property. Now, in this particular case, we had a little problem because title wasn't going to transfer for 5 years. And so the only way that taxpayers could argue that a sale had actually happened is if they had transferred all the benefits and burdens over to this son-in-law's company. You can already anticipate how this is going to go. But what does it mean for benefits and burdens? It's another factor test, unfortunately. But
of course,
yeah, it means who's got a right to possess the property, who's got the obligation to pay taxes or assessments against the property, who's got to insure the property, who's got to maintain the property, who bears the risk of loss if a storm comes and hits that property, right? And so the courts over the years have kind of developed a couple tests. There's this, what they call this economic reality test. And they look at one, what's the true intent of the parties, which is always a disaster, right? When you ask the court to predict intent, that's always asking for trouble. But two, what was the true economic substance of the transaction? And in this case, there's not a lot of suspense here, right? When we think about the intent of the parties, the bank had come to Cuthbertson and said, you got to get this land off your books. And so they didn't go finding an independent party to buy it. They didn't, when they found their son-in-law, you know what he did? He set up a new shell company with $0 in it and purportedly bought this property for a note with no down payment. And so the whole intent was just to move this thing And if they can take a loss while they're doing it, all the better. Now, so the first factor, what was the intent? It doesn't look like there's an intent to actually shift ownership of this property to son-in-law, particularly when what happened next, right? Under the economic substance kind of aspect of this thing, the second prong of the test, they immediately won. What? Leased the property back, took on all the benefits and burdens, all the responsibilities to pay it. Two, they didn't even bother, when you talk about economic realities, if you were going to sell a property, Damien, and you cared about getting the best deal, you might go get the property valued, right?
Generally,
You might want to support what you're selling it for. You might even require a down payment with the $660,000 note you got. They didn't do any of that, and they knew damn well they were never going to get paid on that $660,000 note because, right, son-in-law sold it a couple months later for like $80,000. And so what really happened, right? You may have just dropped this loss on the tax return and not thought anything about it, but what really happened is they artificially created a $110,000 loss despite the fact that they never transferred title and never transferred benefits and burdens of ownership. They're still using the property in their business, paying all the expenses, insuring the property. And so the whole thing was effectively just a shame. Okay. And so just because we think there's a sale for tax purposes does not mean there's a sale. And again, I picked this case because I had to go through, this whole history of this issue this year for another client of mine that, again, the question we were asking is a very, kind of basic one, but very unresolved in the law is, did we really sell this property if we're leasing it right back and have all these benefits and burdens? And, in my case, we were selling it to an unrelated party and there's a lot more formalities. A case like this, the big lessons, are twofold. One, we already said, just because you sold the property doesn't mean you really sold the property. Two, anytime you're selling property to any type of familial relationship or something like that, it's going to, be subject to much greater scrutiny than a normal sale.